Roger Montgomery from Montgomery Investment Management. I'm trying to get to the bottom of a problem and I really want your help. There's a lot of talk at the moment about a tidal wave of fixed rate mortgages established during the historically low fixed rates of 2021 that will soon be reverting to much higher rates. The concern in all the articles I've read is that a fiscal cliff will confront a large proportion of borrowers because rates have risen significantly since those mortgages were taken out, and consequently house prices could plunge further. This chart shows fixed rate mortgage rates dropping below variable rates around the time the RBA reduced its pricing for its term funding facility for banks on November the 3rd in 2020. Around the same time, there was a shift in the proportion of new mortgages written on fixed rates. Just prior to the pandemic, about 16% of owner-occupier mortgages were fixed and 84% were variable, according to the ABS. After the repricing of that term funding facility and all through calendar 21, fixed rate mortgages varied between 33% and 47% of all owner-occupied mortgages written. And that's where the fear-mongering begins. Most articles publishing expert concerns about the plethora of fixed rate mortgages maturing and triggering a collapse in the property market look only at the proportion of all mortgages written in this roughly 16-month period. What I want to know, and what I'm happy to receive your help on, is exactly how many mortgages were written at that time and whether there is actually a cliff we need to worry about. So how did I go about it? Well, I started with looking at owner-occupied mortgages because I know that investment mortgages are fewer in number. Whatever result I come up with at the end of the exercise, I can add a bit more on for investors. The ABS reckons 799,000 new owner loan commitments were taken out in total for construction of dwellings, for newly erected buildings, for existing dwellings, and for first home buyers during the 16 months between September 2020 and December 21. Of course, the ABS discloses when data excludes refinancing, and so from our 799,000 mortgages, we have to adjust for refinancing because they didn't say it was excluded. You can imagine during this period of ultra low rates, a bunch of people will have renegotiated their mortgages and moved on to those lower fixed rates. Another alternative could include these, but I haven't done that. To estimate the proportion of loans that were refinancings, the ABS also publishes mortgage value data split between new owner house lending and owner refinancing. During the period in question, the proportion of monthly loans that represented refinancing was between 55% and 82%. If we multiply the number of loans taken out by the percentage that were genuinely new, we're closer to finding out what percentage of the population or percentage of total mortgages the feared tidal wave actually represents. So next, establish what proportion of the loans were fixed and variable. Fortunately, the ABS provides this data as well. Of course, they're all different time series, so there's going to be gaping holes in this analysis. As I mentioned earlier, fixed rate mortgages as a proportion of total owner mortgages varied between 33% and 47%. Now, before we get to the result, let me say at the outset, working backwards from ABS statistics is going to produce large gaps. And that's thanks to the plague of different time series that are used to try and paint often the same picture. But it's useful to be approximately right. And anyway, we're not going to be exactly right. When I multiply the number of mortgages taken out by owners during the 16-month period in question by 1 minus the percentage refinanced, and then again by the proportion that were fixed, I estimate the total number of new owner loans taken out in the period in question that are up for a rate shock at just 100,304 loans. Now, there are about 10 million properties in Australia, of which 6 million have mortgages, so the proportion we're talking about is about 1.6%. And there are 18,230,000 adults between the ages of 20 and 80. So we're talking about 0.5% of all adults. And even if you say everyone coupled up for their mortgage, it's still only 1%. And if we add on investment loans in the same rough proportions for fixed and variable and adjust for refinancing, you still end up below 2.5% of all mortgages and less than 2% of the population. I'm of course happy for my back of the envelope calcs to be wrong, and very happy for you to contribute a different number. But I reckon whatever the final number, we're talking less about a fiscal cliff that the nation will have to jump off and more of a fiscal gutter that we'll probably be able to step over. That's all we've got time for today, and look forward to talking to you again next week. In the meantime, please follow us on Facebook and Twitter.